Module 5. A closer look at referrals. In the previous module, we covered the flow and content of the buyer's meeting and walked through each slide of the Core 7 Buyer PowerPoint presentation. In this module, we'll focus more closely on making referrals, specifically the why and the how. We'll also cover how to respond when a buyer has a lender in place and how to follow up after the referral. There can be many opportunities in the Core 7 process to refer your partners and compelling reasons for clients to work with your team. Advising clients to meet with your team actually helps your credibility. It underscores that you want them to buy a property when it's right for them and not before. In working with your partners, clients can also benefit from the established communication channels. The process is more efficient because you have a history of working together specific to the home buying process, and your lender can provide a stronger pre-approval letter for the client. Now, although there can be many opportunities for the realtor to refer many of the partners, based on the Core 7 referral pathways, the lender and the real estate attorney referrals are the primary focus. Lender referrals. With that in mind, let's take a closer look at lender referrals. The key here is to make the referral as early as possible. Going back to the rule of thumb we discussed in the last module, if the buyer is purchasing in 3 months or less, refer to your lender partner first. The lender will then refer the financial advisor during the loan consultation when discussing cash flow. If the buyer plans to purchase in more than 3 months, I make the effort to introduce my financial advisor partner first. In that case, the financial advisor would assist in referring the client to the lender at the appropriate time. Now, if your buyer already has a lender in mind, it could mean they have an internet lender, an out-of-state lender, a family member or friend, or have already been referred to another lender. In the Core 7 system, this is where, as a realtor, knowing about your lender's policies can really help. Let me give you an example of how I do it. My lender has what he calls the 0.125% policy. If the client's decision truly comes down to just rate, having a good handle on how my lender operates allows me to respond to buyers in this situation. The way I explain this is, Mr. Jones, if it's just a question of rate, my lender is very fair. He has something he calls the 0.125% policy. What this means is that if he can't match, beat, or at least come within 0.125% in interest rate of an apples-to-apples comparison, he'll release all your information to the next lender and still remain available as a valuable resource for you for the entire process. Do you think that's fair? Now, let's discuss how we handle the situation if your clients have an internet lender in mind. It's very important to let the buyer know that this has the potential to be problematic. We all know that the client is best served by working with a local, brick-and-mortar lender who's familiar with the area and someone whose cell phone you have so you can contact them when needed. I approach this situation very carefully by saying, Mr. Jones, I want you to think about me coming into your kitchen and standing on top of your kitchen table jumping up and down and screaming for you not to use an internet lender. We need to be absolutely sure the money will show up for the closing. In our community, dates are very meaningful and important. They aren't moving targets. If we say we're going to sign the purchase and sale on the 25th, we have to sign on the 25th. If we say we're going to close on the 10th, but we don't show up to close, we could lose our deposit. You'll get a very strong and competitive rate from my lender, and he will show up with the money. If there are any problems, we can reach out to him to address any issues. This is not the same guarantee with an internet lender. I can go into horror story after horror story about internet lenders. If you take away nothing else from me today, or if we don't end up working together, please remember, do not use an online lender. Now, I may have hit that hard, but it's critical for an agent to be able to communicate with an actual person at any time, especially with the Core 7 philosophy. Now, if they have an out-of-state lender, it's best to introduce the possibility of them using your lender without hammering away at it. I approach it by saying, hey, that's terrific. Would it be possible for me to refer my lender to you just to get a second opinion and to show you how we work? A lender in the area may be a better resource for you. Now, you may be in a community where out-of-state lenders are fine, in which case you can disregard this script. The bottom line is that you need to know how things work in your area. If you're in an area with a lot of condominiums, for instance, out-of-state lenders can be extremely difficult to work with. Lenders need to approve both the buyer and the condominium association. It can be a problem for out-of-state lenders who don't have a lot of experience with condominium guidelines to do this, for example. If your buyer is thinking of working with a family friend, on the other hand, it's important to make sure they've done loans in your market and understand its nuances, etc. This is the time to stress the value of the team. Again, you're just meeting your buyer, so I'm not recommending you push the point too strongly. You just want to open the door for them to consider your lender, just in case there's a potential issue. The way I bring this up is, hey, that's terrific. Would it be possible for you to refer my lender to you, just to get a second opinion and to show you how we work? So now, let's take a closer look at the lender referral email that's sent after the buyer meeting. This is huge, and my lender loves it. Remember, in that meeting, you obtain permission to make the introduction. A copy of the referral email is located in the Resource Center and can be customized to mention what the buyer is looking for, a condo, single-family home, or multifamily, for example, as well as any pertinent information if a non-vanilla loan structure is needed. The email is worded very systematically to prepare the lender and to produce the best result. First, this email makes a strong referral by introducing the lender and putting the ball in his or her court to follow up and get all the information. It allows me as the realtor to focus on what I need to do to service the client without worrying about following up to make sure they connect. Now, it's on to my lender to schedule a time to meet with the client and let me know if I need to be involved for any reason. Second, the introduction email includes another reminder about the importance of the buyer gathering all the documentation required under Fannie Mae guidelines. This is a critical step in managing expectations. Instead of saying secondary market guidelines, I prefer to say Fannie Mae. Even though there are other investors on the secondary market, Fannie Mae is the most recognizable to buyers, and they understand the process requires a lot of paperwork to avoid mistakes. In this context, gathering the paperwork at the start feels more than reasonable because no one wants mistakes. Third, by referencing the client's specific needs in the introduction email, my lender is prepared for any issues or concerns when they reach out to schedule the appointment. There's an important reason for approaching the referral in this way. The Core 7 system's secret service rule comes into play here. The goal is to always protect the team members. The process can be very daunting, and sometimes the client wants to place blame for any bumps along the way, including the process being challenging. For instance, the client could complain that the lender is asking for X, Y, and Z before even meeting or speaking. Your job as the realtor is to support the lender and to re-emphasize why it's important by explaining that every document is needed so that the lender can do a good job and help them identify all their options. Always remember, this is a partnership, and everyone on the team needs to support each professional's effort. I want to mention again that we don't encourage pushing or steering clients to work with your team. If the client is resistant, keep in mind that the goal is teamwork in the buyer's best interest. If there's resistance working with your lender, there are two options. The first is that perhaps you could better articulate the value of working with your team. The second option is for you to work with their lender. So what happens if the buyer feels you're steering or pushing them to a lender? There's a script to use to clarify things. Mr. Jones, the lender you choose is absolutely up to you. I can only give you my best advice and expertise in that when you work with a team of people who've worked together in the past, it's in your best interest. I also don't want you to think about the lender as a commodity in terms of you just looking for the best rate. You have to remember that an eighth of a point difference is really just the cost of 1 cup of coffee a week. I want to make sure that you're getting the right advice about the loan structure and what's in your best interest for your plan and your long-term goals. More importantly, if there are problems in the transaction, if the lender and I have worked together in the past, we can pretty much resolve them before we bring them to your attention and possibly cause you stress that could have been avoided. This all underscores the team approach I have. When I look at all the transactions over the past few years that have fallen apart, the commonality is not the lender, home inspector, or attorney I work with. It's the quality of the team's communication. Remember, you're hiring us to manage this process. You're relying on me to be a professional negotiator for you and for everyone on the team to do a good job. Part of the communication is between you and the lender, but another part involves the lender and me. Our interaction covers many nuances: family involvement, price change differentials, and many others. There are items that may not be obvious from your position, but are very important. Again, it's still your choice. All I ask is that you talk with them to see if it may be a good fit. Working with another lender. If the client is working with another lender, or they have a financial advisor who is involved in the process, you want to try to collaborate with them to ensure you're doing what is best for the client. In terms of working with another lender, here's what I suggest to do that is best for the buyer and the transaction. The first step is to introduce yourself and to make sure the pre-approval is valid. Questions I like to answer in this conversation include: did the client provide all their documentation up front? How's the credit rating? Is there any type of debt-to-income ratio issue? If interest rates go up, are they okay? You want to get a sense of where things stand and to find out about any potential issues in advance. I don't claim to be an expert on the lending process, but these are some basic questions that I learned from many meetings with my lender that can help identify potential red flags. Taking the time to get this information benefits their lender as well. In this conversation, you are collecting information that you can relay to the client. This will also bolster their confidence in their lender. Even though this is not your Core 7 lending partner, you still want to support the lender in any way you can, because the key to avoiding process issues is to keep the client moving forward, gathering documents, etc. If my client has really voiced a preference for another lender, and I can call and verify they're doing a good job, I'm good with that, and will always do my best to make sure they stay with that lender. Now, if you have any concerns after speaking with the lender, it's important to alert your buyer. If something is not happening correctly, it's your job to keep them informed. Remember, the buyer does not know or understand the process. Sometimes this conversation may not go over well, but you need to keep them in the loop. Let me give you an example of how I explain this. Mr. Jones, do I have your permission to be candid? I've spoken with your lender, and I'm a little concerned because they have not done X, Y, and Z. I would suggest a few things. Number 1, get all your paperwork to them right away so they can quickly turn this around and also handle any issues or red flags that come about. Let me give an example of a red flag. Let's say your buyer is trying to get an FHA loan, which can be tough with condominium financing. If you discover their lender doesn't have expertise with this type of loan structure, you could go back to the client and say, "Now, Mr. Jones, if this is the loan program you feel you need to do, I'm very concerned that this loan officer doesn't have the experience doing this type of loan with a condominium. I think we should either explore a different loan option with this person or maybe speak with my lender, so we have a backup plan." If there's an issue with the lender, make sure you cover yourself in terms of your advice. This is very delicate and needs to be done in a very respectful manner. You need to ask permission to be candid in advance and back it up in writing with an email. Handled properly, this is an opportunity to add value by demonstrating you act only in your client's best interest. After making the referral, after the buyer has spoken on the phone with your lender, follow up with the client. This can be by email or a quick call where you say, "Just checking in to see how your meeting with the lender went." Sometimes, there may be a lot of technical information involved in the buyer's conversation with the lender, and the client will have questions. It's also a good idea to check in with the lender first, to make sure you can translate the information and support the lender's advice. Here's an example. A frequent comment I hear from buyers is that the lender approved them for more than they want to spend. In this case, you want to reassure the buyer that this is okay and to their advantage. The response I prefer to use in this case is, "It's great that you were approved for more than you originally thought. That's why we want to find a comfort level for you. But at the same time, the lender would not be doing his job if he didn't explain all your options to you. How much you spend is not up to your lender or me. We just want to be sure we're doing a good job for you and articulating all your options." Remember, the pre-approval is all based on ratios. I sometimes use this situation as an opportunity to refer my financial advisor partner, whom my lender has already mentioned, to help our client become even clearer on their decisions regarding money. The dialogue I like to use in this case is, "It's great that you were approved for more than you originally thought. Now, if your comfort level is here and your pre-approval is here, let's figure out what is happening in between. Can I refer you to my financial advisor, who specializes in budgets and fitting real estate into your overall financial plan? Please understand, he'll also help you maximize your tax benefit and will make sure you know all your options. The goal is to help you identify the best strategy and gain some comfort so that if you need to spend an extra $5 or $10,000, it's well within your budget. The Financial Advisor Referral. Now, while we're on the subject of the financial advisor referral, we mentioned multiple times that if your clients are more than 3 months away from buying, it makes sense to speak with your financial advisor first. It's common for buyers to feel hesitant about jumping right into the mortgage process and having their credit pulled when they're more than 3 months away. For this reason, it's the best scenario to refer the financial advisor to discuss certain concerns. For example, where the down payment comes from, budgeting, etc. Sometimes, the property and casualty insurance agent will come up also. Again, following the Core 7 system, the lender and the real estate attorney are the realtor's primary referral targets. But just mentioning the financial advisor and the P&C agent makes it easier for your teammates to make the referral. These conversations come up all the time. Now, let's get back to the financial advisor referral. As you recall from the buyer's meeting module, we talked about the timeline for fitting real estate into the overall financial plan. The financial advisor is brought in to provide a cash flow analysis, to look at where the down payment is coming from, etc. The main reason you want to introduce the advisor at this point is to get a really clear picture of the client's budget. You see, lenders calculate debt-to-income ratios from only housing payments and debt information on the credit report, whereas a financial advisor will dig into the entire client cash flow, looking at what I call lifestyle expenses like entertainment and travel spending. I suggest making this financial advisor referral in the meeting. Then you can use the email template located in the Resource Center to follow up. Now, we've been talking about referrals if you're the buyer's agent, but I want to take this time to quickly go over making referrals if you're the listing agent. You should always look to refer your seller to your Core 7 lender or financial advisor partner also. Your seller is most likely buying someplace else or downsizing and could use some advice regarding the move or what to do with the proceeds. When sitting with your clients, you always want to ask questions from the buyer questionnaire that focus on their relationship with their lender and their financial advisor to make sure you're doing the best thing for them. In your listing presentation, you want to do the same thing. Make sure you're letting your sellers know that you have a team to help them with their overall financial goals. To review, in this module, we focused on making referrals after the buyer meeting. We stressed that the primary referral targets for realtors to make are to the lender, the real estate attorney, and occasionally the property and casualty agent. We covered the timing for these referrals as well as the scripting. We also discussed strategies to use if your buyer has another lender and how to follow up after the referral. In the next module, we'll take a closer look at showings.